The Board of Governors of the Federal Reserve System, the Federal Deposit Insurance Corporation, also known as the FDIC, and the Office of the Comptroller of the Currency are the three entities that make up this agency. OCC issued a joint statement on Thursday, warning about the liquidity risks presented by certain sources of funding from crypto-related entities, and providing some effective practices to manage such risks. The statement was part of a joint response to a statement issued by the Financial Stability Oversight Council, FSOC. The statement serves to remind financial institutions to implement the risk management principles that are already in place. It does not establish any new principles of risk management. They stated that financial institutions are not prohibited from providing banking services to customers of any particular class or type, nor are they discouraged from doing so, provided that such services are permitted by law or regulation. According to the regulators, certain sources of funding from crypto asset-related entities could potentially pose increased liquidity risks to banking organizations, due to the unpredictability of the scale and timing of deposit inflows and outflows. This is because crypto asset-related entities are related to crypto assets. Deposits made by an entity that are placed for the benefit of the entity's customers are two examples of such scenarios. Other examples of such scenarios include deposits that constitute stablecoin-related reserves. It is possible that the stability of such deposits is determined not only by the crypto asset-related entity itself, which is the direct counterparty of the banking organization, but also by the behavior of the end customer or by the dynamics of the crypto asset sector. The regulators issued a warning and added that factors such as market volatility during times of high stress are examples of things that are able to affect the stability of depots. In a broader sense, deposit fluctuations may also be correlated when a banking organization's funding base for deposits is concentrated in crypto asset-related entities that are highly interconnected or share similar risk profiles. As a result, liquidity risk may be further amplified. According to the statement, the Executive Board of the International Monetary Fund, IMF, issued a statement on Thursday stating that virtual currencies should not be given the status of legal tender. The consensus is that in order to protect monetary sovereignty and stability, cryptocurrencies and other digital assets should not be given the status of official currency or legal tender. According to the statement, and with a demand that nations clarify their tax treatment and bring their regulations in line with global standards. This position was formulated following discussions among the 24 directors elected by the IMF member countries after they reviewed a board paper titled Elements of Effective Policies for Crypto Assets, which they receive on February 8. These discussions took place after the directors had received the board paper. Since the occurrence of crypto scams that rocked the global market toward the end of last year, particularly the FTX debacle, there has been a crackdown on cryptocurrencies, which is no longer news but is still important to note. Since that time, a large number of authorities and policymakers have been looking for ways to define the asset class and determine what this means, in the context of our video today if crypto were being discussed. Welcome back at Market Empire. Keep an eye out. Please make sure to subscribe to our channel, give us a like, and leave your thoughts in the comments section below. According to the International Monetary Fund, IMF, significant risks have emerged despite the fact that the potential benefits of cryptocurrencies have not yet materialized. These risks include macroeconomic risks, which encompass risks to the effectiveness of the monetary policy, capital flow, volatility, and fiscal risks. The growing adoption of crypto assets in some countries, the extraterritorial nature of crypto assets and its providers, as well as the increasing interlinkage with the financial system motivate the need for a comprehensive, consistent, and coordinated response. These risks have led them to the belief that member states need to reach an agreement on a comprehensive framework for dealing with cryptocurrencies. The International Monetary Fund, IMF, said that the statement highlighted the view that widespread adoption of cryptocurrencies has the potential to undermine the effectiveness of monetary policy, circumvent capital flow management measures, and exacerbate fiscal risks. The IMF said this view was highlighted in the statement. Due to these concerns, the board of directors came to the conclusion that cryptocurrencies should not be given the status of official currency or legal tender. The directors also reach a consensus on the necessity of developing and applying comprehensive regulations to crypto assets, as well as the necessity of effectively implementing the FATF standards on AML and CFT. In addition, the directors stress the importance of the need for effective implementation of the FATF standards. The statement added, in a nod to the positive potentials of blockchain technology and cryptocurrencies, that regulations shouldn't stifle innovation and that governments can benefit from the underlying digital technology. This was a nod to the positive potentials of blockchain technology and cryptocurrencies. It is becoming more obvious that the International Monetary Fund's (IMF) opposition to cryptocurrencies can be considered an official position, and we can anticipate that anti-crypto restrictions will become a common condition of its loans to economies that are currently experiencing a crisis. As a condition of receiving a loan from the IMF in the amount of $45 billion, Argentina stipulated a year ago that it would discourage the use of cryptocurrencies. It has been less than a year since El Salvador's plan to use Bitcoin as legal tender was met with vocal complaints from the on the left in advance of negotiations on a loan with that country. This announcement came less than a year after those complaints were made. Argentina had been mired in a severe economic crisis for years, with high inflation being one of the fallouts of this situation. The nation is also saddled with a massive amount of sovereign debt and has a long history of defaulting on its obligations, both of which make it difficult to borrow money on conventional markets. In the meantime, as outlined by the bloc, Buenos Aires has developed into a significant center for the development of blockchain and cryptocurrency. Mainly due to the fact that the country's economic and monetary disarray has encouraged residents to search for the comparative security and dependability offered by cryptocurrencies such as Bitcoin. Companies and organizations in the country that deal in cryptocurrencies are reportedly still looking for more information and clarification on what it would mean for their government to discourage the use of cryptocurrencies. But if people in Argentina have come to the conclusion that using cryptocurrencies is a helpful way for them to individually deal with the economic chaos, then why is the International Monetary Fund, IMF, trying to stop them? The reforms are essentially a form of extortion under compulsion, or what American political commentator Naomi Klein has referred to as the shock doctrine. This is because the IMF of their austerity program is often imposed on countries while they are in the midst of a crisis. And despite the fact that they are sold to the public as reform measures that are intended to fix economies in developing countries, they have just as frequently led to even greater levels of suffering. Klein and others have argued that as a result of this, the IMF is fundamentally a stalking horse for global corporations seeking free market reforms. These corporations use the economic desperation of countries as leverage in order to impose policies that allow for greater economic extraction. The given circumstances imply that the International Monetary Fund, IMF, has such a strident anti-cryptocurrency stance because, at the highest level, its raison d'etre is not to support developing economies or to assist the people who live within them. The International Monetary Fund, IMF, is not an impartial aid organization, rather, it is the economic arm of a vast power structure that frequently conceals itself behind the rhetoric of improvement and change. It seeks to attract nations that are considered to be on the periphery or to be developing, as well as those from Africa and Latin America. Cryptography, which is currently a high priority within the post-war neoliberal consensus, poses a threat to that power, despite the fact that the threat is somewhat remote. For the time being, a writer for the Center for Economic and Policy Research named Mark Weisbord describes the International Monetary Fund, IMF, as a gatekeeper for a creditor's cartel of Western funders. This cartel also includes the World Bank and the Inter-American Development Bank. But as El Salvador is attempting to show with its volcano bond, and as donations to Ukraine have recently shown even more dramatically, cryptocurrency is not simple to gatekeep. This can be seen in both the positive and negative ways. It is entirely conceivable that less powerful nations such as El Salvador will, in the not-too-distant future, have access to an alternative crypto-based debt and financing market over which the Western order has only a limited amount of influence. Even a small financial escape hatch could provide meaningful leverage for pushing back against the IMF and its power-driven agenda. That market will certainly be small in comparison to the overall global banking system, however, even a small financial escape hatch could provide such leverage. The actions of the International Monetary Fund, IMF, imply that they are aware of the possibility and are petrified of it. What are your thoughts on the recently implemented policies by the IMF and other financial organizations? Share your thoughts with us in the section below. In addition, make sure to click that like button, subscribe to our channel, and enable the notification bell so you won't miss any of our future videos.